What's going on, everyone? My name is John with Value and Mortar, and I'm an economist. Today, we're talking about how to analyze a rental property before you buy. In the last video, we broke down how to read a business through revenue, profit, cash flow, and debt. A rental property is smaller and more tangible, but the same discipline applies. You're still buying an income-producing asset. The property brings in revenue, absorbs expenses, requires reinvestment, and may carry debt that has to be paid whether the math goes well or not. The danger is that a rental can look profitable in a listing and lose money in real life. A seller shows you the monthly rent, and a calculator shows you the mortgage principal and interest. The space between those two numbers looks like profit, but that space is where vacancy, insurance, taxes, repairs, management, capital replacements, and financing risk live. We'll build one analysis from gross rent to cash flow, then stress test the deal. If you want more practical frameworks for understanding productive assets before you put money into them, subscribe and keep building the framework with us. We're connecting personal finance, business ownership, stocks, and real estate through the same core ideas: cash flow, resilience, and disciplined ownership. You don't start with the asking price, you don't start with the neighborhood photos, you don't even start with the projected appreciation. You start with the economic engine. What income can this property reasonably produce? What does it cost to operate? And what remains after the debt is paid? That sounds simple, but most weak rental analyses collapse several different numbers into one. Gross rent gets treated like income. Mortgage principal and interest get treated like the full cost. Repairs get treated like rare surprises. The down payment gets treated like the entire cash investment. When those shortcuts stack together, an average property can look like a great deal. A great analogy from sports are the Oakland Athletics, also known as the Oakland A's. Back in 2002, they became associated with a different way of evaluating baseball players. Instead of leaning only on familiar scouting impressions and traditional headline statistics, the organization placed more weight on measures such as on-base percentages that were more closely connected to producing runs and winning games. This ended up inspiring the movie Moneyball, which stars Brad Pitt. The lesson for a rental investor isn't that real estate is baseball. It's that the most visible statistic isn't always the statistic that drives the outcome. Gross monthly rent is the batting average on the listing. It's easy to see and easy to repeat. Net operating income and cash flow tell you whether the property's economics actually work. Let's use a fictional property for an analysis to get a better idea of what the numbers look like. Assume a single-family rental home is offered for $300,000. Market rent appears to be $2,600 per month. That gives us $31,200 of gross scheduled rent for a full year. Gross scheduled rent means the rent you would collect if the property stayed occupied and every payment arrived in full on time. It's not the amount you should expect to keep. The first deduction is vacancy and credit loss. Vacancy is the time between tenants or any period when the unit isn't producing rent, so there's no one living in your rental home. Credit loss is rent that was scheduled but not collected. Even a good property in a healthy market won't necessarily stay occupied and fully paid every day of every single year. For this example, we'll assume a 5% vacancy and credit loss factor. 5% of $31,200 is $1,560. Subtract the gross scheduled rent and the property has $29,640 of effective gross rental income, or an average of $24.70 per month. However, that 5% is an assumption, not a universal rule. Things happen. A property with long periods of time in between tenants, heavy seasonality, weak local demand, or rents being charged above the market may need a larger deduction. A property with stable tenants and strong demand may perform better, but you still shouldn't underwrite for perfect conditions ever. You can estimate vacancy by checking comparable rental listings, asking how long similar units remain available on the market, reviewing the property's lease and payment history when available, and speaking with property managers who actually operate in the local area. The point is to use evidence, not the number that makes the deal look best. Now we move from effective rental income to operating expenses. Operating expenses are the recurring costs required to keep the property available, legal, insured, maintained, and rental worthy. For a typical small rental, that can include property taxes, landlord insurance, routine repairs and maintenance, property management, homeowner association dues or HOA fees, owner-paid utilities, landscaping, pest control, licensing, and other recurring local costs. For our fictional property, let's use these annual assumptions. Property taxes, $4,200. Landlord insurance, $2,160. Routine maintenance, $1,800. Property management, $2,496. Equal to 8% of gross scheduled rent. Homeowners association dues, $600. Landscaping and pest control, another $600. That produces $11,856 of recurring annual operating expenses. Subtract the $11,856 from $29,640 of effective annual income, and we get $17,784 of net operating income, which is usually shortened to NOI. NOI is the property's income after normal operating expenses but before financing costs and income taxes. The mortgage principal and interest are not included in NOI because NOI is meant to measure the property's operating performance independently from the buyer's financing choice. That distinction matters because two investors can buy the same property with completely different down payments, interest rates, and loan terms. The property has the same operating economics, but each investor can end up with different cash flow numbers. You also need consistency in how you treat management of the rental. Even if you plan to manage the property yourself, which saves you money on property management but requires more of your time and attention, but we'll talk about that another day. Include a realistic management expense in your analysis. Your time has value, and a property that only works because you assume permanent savings on management costs is weaker than it looks. It also makes the deal harder to compare with a property that's professionally managed. The same principle applies to maintenance. Don't allocate $0 to it because the house looked clean on the day you walked around the property. A roof that was installed recently may reduce near-term risk, but plumbing still leaks, appliances still fail, tenants still move, and small repairs still tend to accumulate. NOI gives us a much more useful picture than gross rent, but it still isn't the cash that reaches your pocket. The Office of the Controller of the Currency defines NOI as annual gross income less operating expenses and emphasizes vacancy, operating costs, capital expenditures, replacement reserves, and stress conditions when assessing an income-producing property. Now let's talk about capital expenditures, which are related to routine maintenance, but they're not the same. Look at it this way. Routine maintenance keeps existing components working, while capital expenditures are larger, less frequent replacements or major improvements that extend the property's useful life. Some examples are a roof, the heating and air conditioning system, water heater, major plumbing line, painting of the exterior walls, or replacing appliances. All these can create a large need for cash even if the property looked profitable for the previous 11 months. Some underwriting systems include a replacement reserve inside operating expenses when calculating stabilized NOI. Other investors show the reserves directly below NOI, but either method can work if you're consistent and don't pretend the future replacement cost is zero. For this example, we'll show a separate capital reserve of $2,400 per year or $200 per month. That takes the $17,784 NOI down to $15,384 of cash available before financing. The reserve should be tied to the property, not copied blindly from social media rules. Start with the age of the property, expected remaining life of the property, and replacement cost of the roof, heating and air conditioning system, water heater, appliances, exterior surfaces, and any other major landlord responsibilities. Then annualize those future costs. Let's run a simplified estimate for replacing a roof to make the idea clearer. If a roof may need replacing in 10 years and you estimate that replacement at $15,000 of today's money, allocating roughly $1,500 per year toward that component gives you a starting point to go off of. It isn't a prediction, it's just a recognition that the roof is accumulating wear and tear every year, even on the years when the roof is seemingly fine with no leaks or anything like that. The Apollo 13 space mission offers a useful way to think about reserves. After an oxygen tank rupture forced NASA to avoid the lunar landing, the crew and mission control had to manage limited oxygen, power, water, temperature control, and carbon dioxide removal from the air they breathed to get home safely. The crisis wasn't solved by pretending the remaining resources were unlimited. Survival depended on knowing the constraints, preserving margins, and planning around failure. A rental property reserve serves a much less dramatic purpose, but the economic principle is similar. Cash reserves give you options when a major system fails, such as a tenant leaving or insurance and taxes rising at the same time. Without reserves, the property can force you to use expensive debt, delay necessary work, or inject personal cash at the exact worst moment. Returning to our fictional rental property, now we add the mortgage loan. Assume the buyer puts 25% down on the $300,000 property. The down payment is $75,000 and the loan amount is $225,000. For illustration, assume a 30-year fixed loan at 7.25% interest. This is just a hypothetical financing assumption, as interest rates vary. The monthly principal and interest payment is approximately $1,534.90 or about $18,418.80 per year. Remember that principal and interest are not the property's full cost though. Taxes, insurance, mortgage insurance when applicable, association dues, and other charges may be paid separately or included in the total monthly mortgage payment. In our example, property taxes and landlord insurance are already counted in operating expenses, so we subtract only principal and interest here to avoid counting them twice. We had $15,384 of cash available before debt. Subtract approximately $18,418 and 80 cents of annual debt service, and the deal produces negative cash flow of about $3,034.80 per year or negative $252.90 per month before income taxes. This is why gross rent math can be dangerous. A buyer might look at $2,600 of rent and a principal and interest payment of $1,535 and imagine more than $1,000 of monthly spread. However, after vacancy, operating expenses, and a capital reserve, the same deal loses roughly $253 per month under these assumptions. That doesn't automatically mean the property is worthless. A buyer may expect rent growth, may negotiate a lower price, may use different financing, or they may add value or may accept low current cash flow for another well-supported reason, but those are separate arguments. The existing economics should be visible before you rely on a better future. Debt can increase your return on the cash you invested when the property performs well. It can also remove your margin of safety because the lender gets paid before you do. One useful measure is the debt service coverage ratio, or DSCR. That is net operating income divided by annual debt service. In our example, that's $17,784 of NOI divided by about $18,418.80 of debt service, which gives you a DSCR of approximately 0.97. What does this mean? A ratio below 1 means the property's NOI doesn't fully cover the scheduled debt service. Small residential lenders may qualify a borrower using personal income and their own underwriting rules, so this ratio isn't necessarily the lender's approval test. For the investor, though, it's a useful warning that the property itself isn't carrying the debt. You should also measure loan to value, or LTV. That's the loan amount divided by the property value. A $225,000 loan on a $300,000 purchase is 75% loan to value. The remaining 25% is the initial equity before closing costs and any immediate repairs, the down payment. Higher leverage reduces the cash required up front, but it raises the fixed payment relative to the property's income. It also leaves less room if the property value falls, refinancing becomes expensive, or you need to sell during a weak market, like many sellers on the real estate market in the US right now. The real test isn't whether the base case barely works. The real test is what happens when one or two assumptions moves against you. So run at least 3 scenarios. The base case uses assumptions you can defend with current evidence. The downside case raises vacancy, maintenance, insurance, taxes, and financing costs where relevant. It should also include at least one realistic capital event, such as replacing the appliances. The severe case asks whether you could keep the property through a concentrated problem, such as an extended vacancy combined with a major repair like replacing the roof. For our example, imagine one full month without rent and a $4,000 heating and air conditioning replacement in the first year. The property loses $2,600 of rent and absorbs a $4,000 immediate need for cash. A reserve reduces the shock, but it doesn't make the cost disappear. If the base case was already negative, the downside case becomes a liquidity problem quickly. That is leverage risk in plain English. The debt payment stays fixed while the property's income decreases and expenses increase. So before you make an offer on a property, build one clean annual analysis. Then ask 4 final questions. Are the rent and vacancy assumptions supported by the local market and the actual property? Are all recurring expenses included, even the costs that the current owner avoids or performs personally? Is the cash reserve tied to the age and condition of the major systems? Does the deal still have enough liquidity and cash flow capacity when the downside case arrives? A strong rental deal doesn't need perfect certainty, as investing in real estate always contains uncertainty. What it needs is a clear economic case, conservative enough assumptions, and enough margin that 1 year or one vacancy doesn't destroy the plan. The main takeaway is simple. Rent is revenue, not profit. NOI measures the property before financing. Capital reserves acknowledge that buildings wear out. Debt determines how much of the property's operating income reaches you and how much risk remains fixed when conditions change. Take the numbers out of the listing and rebuild them yourself. That's how you stop shopping for a house and start underwriting an income producing asset. In the next video, we'll return to the business ownership series and ask what makes a great business. We'll take the same discipline we used here and apply it to moats, pricing power, and returns on capital so you can distinguish a company that merely earns money from one that can defend and compound those earnings. Subscribe so you don't miss that next step. We're building a practical ownership framework across businesses, stocks, and real estate. And each video is designed to make the next asset easier to evaluate. Drop a comment with the expense or risk you think new rental investors underestimate most. This has been John with Value and Mortar, signing off.